I don't know who you are, I don't know what you do, and I have no idea what your story is. But what I do know is that if you're watching this video, there's a pretty good chance that you aspire for a better future for yourself. Now, if you already have your perfect life, then you can skip this video and have a great rest of the day. If you don't, and if you're still working for something greater, or if you're looking for something greater, I believe I'm about to share with you the single greatest opportunity that exists in America today. And to the extent that you would take advantage of this opportunity, your life could change for the better forever. And I understand that this is a really bold statement to make, but if you give me 5 minutes, however long this is gonna take, 5-10 minutes, whatever it is, then I will prove to you with statistics, with facts, with actual historical data that this is actually going to take place, and this is something that you, no matter who you are, no matter what your background is, you can actually take advantage of and create wealth for yourself, right? So, that being said, let's get into it.
All right, here we go. The Great Wealth Transfer. So by 2037, there's $68 trillion, that's trillion with a T, that has to be transferred out of where it's currently sitting. Now, the reason why this is going to take place is threefold. There are three reasons for this transfer. Number one is personal choice. Number two is IRS Tax Law. And number three is the death of the account holder or the death of the owner of these funds, right? So let's talk about it a little bit. Number one is personal choice. So first of all, we need to know who it belongs to, which is the boomer generation. So baby boomers between 1946 to 1964, you have 76 million babies that are born. And then I'm from Iran, so like people like my parents or immigrants that moved over from different countries, all those people combined, their net assets end up being this $68 trillion. Now, these guys are at they're at a stage in their life that security is really important, right? So they've gone through a lot of crashes, they've gone through a lot of volatility and a lot of drama within their lives. And so they've gone to a point where security, because they're trying to retire, they don't want to have too much drama anymore, security is a big deal, right? So that being said, in 2008, when the mortgage bubble burst, the average 401k, IRA, mutual fund, this average retirement account that's inside these volatile markets lost 30 to 40%, right? What does that mean? So if you can imagine that you've been saving for 40 years and you turn 59 and a half or 60, because that's the age that you can actually touch your 401k, and in 2006 is when the first group of these boomers actually hit that age of 59 and a half, that's 60. So 2006, they hit 60. In a couple of years, they're thinking about retiring. And 2008, the crash happens and they lose 40% of their life savings in literally 6 months, right? So you panic and you say, okay, well, dude, what dude, I don't know if they said dude, but you'll panic and you'll be like, oh my gosh, what do I do? And so that crash, and then you have another crash, and then let's say another crash. You're already in retirement, you're getting close to retirement, so you just start valuing this concept of security a lot, and you start pulling your money out because you want, at least I don't want to lose any more money. I'd rather sit in a bank CD, get 0.5%, and at least not lose any more money than still be in this thing and risk it. You know what I'm saying? So security became a really, really big deal. So that was reason number one. Reason number two is IRS tax law. So what does that mean? Most people know about that 59.5 rule. So most people who have 401ks, who have IRAs, they know about this rule that says you have to wait until 59 or 59.5, whatever, 60. Let's say you have to wait until 60 to be able to pull the money out of this account. Otherwise, you have to pay penalties, right? You still have to pay taxes no matter if you wait, like if you do it after 60, you'll still have to pay taxes on your money. But if you do it before 60, you also have to pay a penalty. So most people know about this rule. What most people don't know about is the 72 rule. And what does that mean? That means that if you don't take your required minimum distributions, or they also call it a required withdrawal, like minimum withdrawal, the IRS is going to take 50% in taxes, or fees, whatever you want to call it. But at the very least, it's 50%. This is an actual IRS tax law. The RMD law is an actual law that's attached to 401ks, IRAs, like these traditional retirement accounts. If you don't touch your money by the age of 72, you're going to pay 50%. Now, here's why this is important, right? So why would even anybody wait until they're 72? Because you got to remember, in 2008, the market crashed. And then we'll actually show you like a visual of this in a couple of slides as well. But the 2008 market crashes. You lose 40%. First choice is, okay, I'm gonna pull my money out because I want security. Second choice is I'm 60, 59 and a half. I'm still young, right? I could work another 10 years, I could work another 15 years, and the market always comes back. So I'm gonna keep working, I'm gonna keep saving. When the market comes back, then I'm gonna retire. But then the IRS says, you have until this age. You got to make these withdrawals until at that age. If you don't make these withdrawals, I'm taking 50%. They want their cut. Believe it or not, Uncle Sam is the biggest gangster in the world, right? He wants his cut. So the IRS is not going to, they're not going to take this laying down. Either you make your withdrawals and they take their taxes out, or if you just leave it in there, they're going to take their 50% anyway. This is an actual IRS tax law. So the last group of these boomers, the last group of those people between 46 to 64, the 1964 group, they hit the age of 72 on or around 2037, which is the number that we talked about at the top. So 2037 is the deadline. These group of boomers is going to hit this age of 72 around that time, which means by 2037, the money has to be used or moved. It has to be. It must be. Otherwise, 50% is going in taxes. Okay? Give it a sign. So first one was what? Personal choice. And now we have taxes that we've covered. IRS tax law. Third one was death of the owner, right? So if the boomer dies, their heir won't be able to get access to the money without paying estate taxes or without avoiding probate because it's sitting in a mutual fund, it's sitting in an IRA, it's sitting in a 403b or a 401k. These things aren't protected against estate taxes. They're not protected against probate. And probate means that basically the government holds on to your money and they say when it's appropriate to pass it down to your beneficiaries. So any money that the boomer doesn't use that's sitting inside these accounts and they want to transfer it to their heirs upon their death is either going to be subject to estate taxes or it's going to get stuck in probate unless they plan otherwise. Okay? So knowing these things, now we have two new questions that come up. Number one is, what is the solution? And number two is, what does it have to do with you, right? Because we talked about at the top of this thing that I'm going to share this opportunity with you. And if you're willing to ride on this, if you're willing to actually take it seriously, it can transform your life. So what does all of this that I shared with you actually have to do with you? So let's talk about that a little bit. The solution is what? There's something called an indexed annuity. It protects against market crashes and it provides secured growth. It counts as your required minimum distributions when you take an income out of your annuity or if you actually take your minimum withdrawals, right? It actually counts as those things. So it takes that 50% tax away. And it protects against estate taxes and probate because of the fact that it's a contract that's only available through insurance companies. So because of the fact that they've protected against with life insurance law, you literally don't have to worry about estate taxes for your beneficiaries, nor do you have to worry about probate. They just transfer the money immediately to your beneficiaries. Here's what it actually looks like. So you have two lines here. The red line represents the S&P 500's performance between 1998 to 2013. If you look at any 15-year period, you'll see that there's at least one or two corrections. These slopes, these downward slopes that you see right here, it's very, very common to be able to see a correction or a crash or a bear market, whatever you want to call it. You see at least one or two of these every 10 to 15 years, right? So if you have two people that start with $100,000 and they're going in the same market, so this is the S&P 500's performance in these years, and if the second person goes in an index against the S&P 500, this is what it looks like. And basically, the reasoning behind it is this. If you open your account with Fidelity, let's say, you open an index annuity with Fidelity, market goes up 50%, which is what happened basically in these first 2 years. Instead of getting that 50,000, you only got 25,000. Fidelity kept this difference right here. The reason why they keep the difference is because they have to be able to afford this part. When it tanks, you lock in your gains and you just stay where you were. And then when the market comes back up, you just pick up from where you left off. And so it goes up right here. When it tanks, again, you just flatline and you stay where you were instead of picking up from down here. So the same 100,000 ends up being 228 on this one and 146 on this one. Now, these lines look somewhat different when you kind of go across the timeline of the markets, but the concept stays true and this stays the same. And if you were to talk about the boomer generation specifically, because we're not talking about a young person who's 20 years old that they can afford the risks of the market, they're going to be in it long term. That's not what we're talking about. We're talking about people who are in their 50s, 60s, going to 70, that they need security. And so it's either the index or something that's fixed. And the same annuities that are available through these companies actually have fixed rates that are higher than the 0.5% that the bank is paying, right? So you can get a fixed account that's even better, or you can get an indexed account that's even better. So what does this have to do with you? This is the important part. This is where it all gets super sweet. A rollover into an annuity means that if you roll over a 401k into it, or if you roll over an IRA into it, a bank check means you write a bank check for it, right? So if you do a rollover into annuity, or you open one with a bank check, doesn't matter. It pays out between 6% to 8% in commissions for this account, which means what? Our field associates get 50% of that. Our marketing directors get 75% of that. So if you have a $100,000 account, 6% on that $100,000 would be $6,000. And if you're at 50%, you would get paid $3,000 on that. I know people that have to work an entire month to get paid $3,000, and I know people who work an entire month and don't even get paid $3,000. And you can do it with one transaction here. It takes literally a couple hours. It's like opening up a bank account, basically. That's what it looks like. So this is what it looks like if you're doing a $100,000 rollover, or a $100,000, a new account. The average 401k in America has about $250,000 in it. The average 401k in states like California, New York, or maybe Texas, Florida, these like high income states, the average 401k in those states is $500,000. If you do a 401k rollover for $500,000, retirement account, they give you a check, whatever. Same exact situation, 6% of it would be $30,000. If you get 50% of that 6%, you would get paid $15,000 in one transaction, right? So I know people that have to work, 3 to 6 months to make $15,000, 7 to 8 months to make $15,000. And you can actually do it in one transaction. So this is the scope of the opportunity that's available to you. And I literally said this at the very, very top of it, that if you actually take it seriously, then you can stand to make life-transforming moves in the next 3 months, in the next 6 months for your life. Literally everything can be different because of the fact that it's financial services. There's $68 trillion that has to transfer. This is the type of pay that comes with just asset management and being in retirement planning. And this is what you have available to you. So now, the next steps would be to actually get your questions answered, speak to somebody from our team, anything like that. And I'll kind of hop into it and do a closeout message anyway. But if you do decide to do it, you would get your broker code, you would get your licensing studies with the state of California, and then really just start building your agency and start building your book of business and start making money. So this is kind of what it looks like. I mean, this is pretty much what it looks like when you look at the scope of the timing of the specific opportunity in the financial services industry in America today. So now we're gonna leave this and then we're just gonna do our closing message real quick.
All right, so you saw the opportunity, you saw the timing in the marketplace, you saw the requirements for licensing and what you gotta do to actually make money. And so really the only question that's left is, can you see yourself doing this? And in my opinion, obviously I think you can, but if you're not from finance or if you're not from the world of sales, it might seem a little intimidating. So I will say this to you. We have an amazing support staff and an amazing support system for anybody who's not from the industry. 95% of our agents are not from the industry. They're actually from different backgrounds and different walks of life. And they end up doing really well here because we actually have the infrastructure and the systems in place. We work with an amazing company that they actually have over 18,000 licensed agents in America. There's offices in every single one of the 50 states in America. So there's an amazing support system, some place that you can always go into to get support. So you're definitely not gonna be by yourself as you're going into this. So really the only question that's left is, why not you? Why else would you not do this? Because if it's a matter of experience, we can help you with that. If it's a matter of time, you can do it completely part-time. So really, why not you? If you really want that great thing for yourself, if you've watched this video up until this point, if you've actually stuck it out this long with me, then there's probably a great likelihood that you want something amazing for your life. You actually do want something great for yourself. And it's just that close. It's literally a matter of making a decision that says, you know what, I don't know what's gonna happen, but I'm gonna figure it out. It's not my industry, not my background, whatever, but I'm gonna make this work. I'm gonna figure this out and I'm gonna make this work. And if that's literally the only decision that you have to make, I think it's a pretty easy decision. So now, I would love to work with you. I would love the opportunity to get to know about more of your story, try to figure out what makes you tick, why you want to do this, and how I can actually help you do it. So if you're ready, if you've stuck it out this far, and if you really want something, because it's not for the people that are, it's like, you gotta want it. If you really want something, then hit me up. My calendar link should be below. You can literally book an appointment with me right away, and then we'll get on the phone or on Zoom or something like that, and we'll chop it up, see what your story is, see what your ambitions are, and if there's any way that we can actually work with each other. I would love to meet with you. I would love to work with you, but ultimately it's going to be your choice. So let me know. And in either case, and whatever ends up happening, I hope you have an amazing year ahead of you, and I wish plenty of prosperity and success on you and on your family.